Now then, the markets have been doing something moderately alarming last week and this week, and I have no doubt in my mind that everyone is freaking out and wondering what the hell they should be doing or how they should be behaving before making some rash decisions. I feel like this video should be accompanied with some breath work to help you calm down, but maybe another time. So what on earth is going on? And that's why today we're going to go through all of it. Every reason the market is wobbling right now. And I'm going to count them for you because honestly, there are 7 of them, which is a lot. Even by 2026 standards, which have not exactly been a relaxing year. The good news, and there is good news, is that understanding why markets are failing is 90% of the work of knowing what to do about it. So let's get through the 7 and then I'll tell you what I actually think you should do. But before we go any further, this is not financial advice. Your situation is your own. Seek financial advice if you're concerned about your position. Let's go. I'm Leo. Welcome back to Financially Fit Millennial, where we explain this stuff without the panic or making your head explode. If you're new here, today might not be the most relaxing introduction to the channel, but it's probably one of the most useful. 7 reasons, let's run through them. Quick bit of context first. The S&P 500 hit an all-time high about 7,600 on June the 2nd, literally this time last week. By Friday, it had pulled back to around 7,400. So we're not talking about a catastrophic collapse. We're talking about a market that just ran to a record, got very excited about itself, and is now having a little bit of a thing. But the reasons behind the wobble are worth understanding properly, because several of them are not going away quickly. Reason 1, the Iran conflict and the oil shock. In March this year, the US-Iran conflict escalated sharply. Iran fired on ships attempting to pass the Strait of Hormuz, a narrow waterway through which approximately 13 million barrels of crude oil pass every single day, which is, to put it mildly, quite a lot of the world's energy supply going through one very tense shipping lane. Oil spiked, Brent crude hit $119 a barrel at the worst point. That's not far from the levels that triggered a global inflation crisis last time. Markets fell sharply. The S&P 500 wiped out all of its 2026 gains in a single week in early March. Then a fragile ceasefire was announced. Oil fell back to around $86 and markets recovered somewhat. Right now, Brent is sitting around $96. The ceasefire is described diplomatically as fraying. Congress passed a resolution trying to limit military action. Trump said a deal was close. The market is not entirely convinced. So why does this matter for your investments? Because if oil pushes back through $130, which is not off the table if the ceasefire breaks down, any hope of interest rate cuts evaporates instantly. Energy costs filter into everything. Transport, manufacturing, food. Inflation goes back up. The Fed can't cut. In fact, rate hike talks re-enter the conversation, and that is a very different environment for stocks. Not a certainty, but it's the wild card everyone in the market is watching most closely right now. Reason 2, tariff uncertainty. Yeah, tariffs again. This one feels almost darkly comical now, although to be fair, we shouldn't really laugh about it. Here's where we are. The Supreme Court voided most of the 2025 tariffs earlier this year. Markets celebrated. Then the administration reinstated a 10% global tariff as a baseline. Markets shrugged. Then Treasury Secretary Bessent warned that tariffs could return to their previous significantly higher levels by early July 2026, which creates a very specific kind of uncertainty that markets absolutely hate. Because companies can't plan. They can't set prices, lock in supply chains, or commit to investment when the tariff environment could change dramatically in 3 weeks. This uncertainty is a direct drag on corporate earnings. And earnings ultimately are what stock prices are based on. If companies can't predict their costs, they can't predict their profits. If they can't predict their profits, analysts can't model them accurately. And if analysts can't model them accurately, valuations become a guesswork, which is not a stable foundation. Reason 3, Inflation that won't sit down. Inflation is sitting stubbornly near 3%, which sounds almost reasonable until you remember the Fed's target is 2%, and that gap is proving very hard to close. The reasons are several. The labour market remains tight, people are employed, they're spending, and that keeps price pressure elevated. Tariff pass-through is adding to costs, and the housing component of inflation, which is notoriously slow to adjust, is still showing up in the data, even though actual rents have cooled in many cities. Then this week, a strong jobs report landed, which should be good news, and in normal times it is. But right now, a strong jobs report means the Fed has no reason to cut rates. As Lazard's chief market strategist puts it, and I'm quoting directly here, any hopes of a Fed rate cut have been effectively eliminated. Higher for longer rates means more expensive borrowing for companies. More expensive borrowing compresses profit margins. Compressed margins means lower earnings. Lower earnings justify lower stock prices. This chain of consequences from a sticky inflation print is why a good jobs report can perversely send markets down. Reason 4, the semiconductor sell-off. 1 trillion gone in a day. This is the freshest one. Last week, Thursday, June the 5th, the Nasdaq fell sharply as the semiconductor sector had what can only be described as a very bad day. Micron Technology down 6.3%. Advanced Micro Devices also down 6.3%. Marvell Technology down 8%. The semiconductor index, which had been one of the biggest drivers of the market gains this year, wiped approximately $1 trillion from global markets in a single session. The trigger was Broadcom's earnings, which stoked concerns about whether the AI infrastructure spending cycle is starting to slow down. For context, semiconductors have been amongst the biggest beneficiaries of the AI boom. If that story starts to look wobbly, it removes one of the main engines that's been pulling the market higher. The important context here is that even after this sell-off, semiconductors are still up significantly for the year. This is a stumble inside a bull run, not a collapse, but when a sector that represents a huge portion of the market's recent gains starts selling off, it gets people's attention, and rightly so. Reason 5, the Buffett indicator is flashing. Now, this one is more structural, less about this week or last week, more about the overall picture. And it's the one that makes people who study valuations genuinely uncomfortable. The Buffett indicator, which measures total US stock market capitalization against GDP, is currently sitting at 227%. To understand why that matters, Warren Buffett himself described levels above 200 as playing with fire. We're now 27 percentage points past the point that the greatest long-term investor of all time called playing with fire. Make of that what you will. The CAPE ratio, the cyclically adjusted price to earnings ratio, which smooths out short-term swings and gives a longer-term valuation picture, is also historically elevated. Both of these measures say the same thing. The market has very little cushion. If earnings disappoint, if the AI spending boom doesn't deliver the returns the market has priced in, there's not much valuation support to catch the fall. Reason 6, market breadth is terrible. The thin ice problem. Here's the sneaky one. The one that's not obvious when you just look at the headline index numbers. The S&P 500 and the Nasdaq have been at or near all-time highs. That sounds great, but if you look underneath the surface at what the average stock in the market is actually doing, the picture is considerably less rosy. The median stock in the market is currently 13% below its 52-week high. Not the index, the typical average stock. The rally has been carried almost entirely by a handful of mega cap technology companies. The Magnificent Seven: Apple, Microsoft, Nvidia, Alphabet, Amazon, Meta, Tesla. They make up approximately 37% of the entire S&P 500. So when 7 companies are doing the heavy lifting of an index of 500, and those 7 companies have a bad week, the index goes down hard. Analysts are calling this breadth deterioration, not seen since the dot-com era, which is, and I'm choosing my words carefully here, not a comparison anyone wants to make. And finally, reason 7, the most boringly predictable one on the list, seasonal weakness. There's a well-documented historical pattern in markets. The May to October window historically returns only about 1.7% on average. The November to April window, over 7%. It's the basis of the old sell in May and go away. Now, I'm not suggesting you actually sell in May and go away. Market timing is a fool's errand, and we've covered that extensively on the channel. But the seasonal pattern does mean that summer 2026 is statistically starting from a position of lower average returns. And with all 6 of the other reasons I've just listed converging at the same time, geopolitical risk, inflation, tariffs, semiconductors, extreme valuations, and thin breadth, it's a particularly ill-timed period to have a seasonal headwind as well. Life is rarely boring. Markets particularly so. So what to do about it? Right, 7 reasons, all real, all backed by actual data. Now, here's what you do about it. 1, understand the difference between a correction and a collapse. The S&P 500 hit an all-time high. It's down about 0.5% from that level as of Friday. That is not a crash. That is a market that just got very excited, ran into a record, and is taking a small breather. Corrections of 5 to 10% happen regularly, roughly every year on average. They are normal. They are healthy. They are the price of admission for long-term returns. Even if this develops into a more significant pullback, which it may or may not, the historical record is unambiguous. Every correction in the history of the market has been followed by a recovery to new highs. Every single one. 2, don't sell. I know, it feels counterintuitive when you're watching 7 reasons pile up in front of you. But selling now means you have to be right twice. You have to correctly time when to get out and correctly time when to get back in. The data on how reliably people do that is not encouraging. As we've covered in the dollar cost averaging video, missing just the best 10 days in the market over 20 years cuts your returns roughly in half. The best days in the market almost always come right in the middle of the worst periods. Selling during corrections is how you miss them. 3, if anything, this is a reminder to check your risk profile. If the last week has caused you genuine anxiety, not mild curiosity, but actual stress, that's useful information. It tells you that your current portfolio may be more aggressive than your psychology can actually handle. And that's fixable, but the fix is not panic selling. The fix is considered, calm reallocation to something that better matches your actual risk tolerance. We've got the free risk profile quiz at financiallyfitmillennial.com. Takes 2 minutes. The link's in the description. If this week made you uncomfortable, it might be worth having a look. 4, keep investing. If you're on a dollar cost averaging plan, monthly contributions into an index fund, keep going. Don't stop. A market pullback means you're buying at lower prices than you were last month. That is not a bad thing. That is the strategy working exactly as intended. Scary headlines are the noise. Your monthly contribution is the signal. Trust the signal. All right, 7 reasons the market is wobbling. Iran and oil, tariffs again, sticky inflation, the semiconductor sell-off, extreme valuations, thin breadth, and seasonality. All converging at once, all in the same summer, which is, I'll admit, quite a lineup. And yet the S&P 500 is still up roughly 10% for the year. It hit an all-time high a few days ago. The fundamentals of the broader economy, employment, corporate earnings, consumer spending are not falling apart. This is a complicated, uncertain, uncomfortable moment. It is not, at least not yet, a crisis. Stay informed, stay invested. Don't make permanent decisions based on temporary noise. If this helped, share it with someone who's been spiraling over their portfolio this week. They need to hear it more than most. Subscribe if you haven't. Drop a comment below. Which of the 7 are you most worried about? All right, legends. I'll see you in the next one.